Hello traders, this is a full ICT beginner trading course in which I will describe each thing in a way that you will understand easily. Let's get straight into it. First, let's look at the concepts I will explain. The first concept will be liquidity, including internal range liquidity, external range liquidity, higher time frame liquidity, and lower time frame liquidity. Then we will cover fair value gap, then inverse fair value gap, then order block, then breaker block, then change in state of delivery and market structure shift. Then I will explain the daily bias and draw on liquidity, then premium and discount and standard deviation, and then I will explain the ICT day trading model. And lastly, I will explain the ICT scalping model. First, I will explain every single concept individually and explain how to use it, and then we will combine everything and use it on the charts. Now let's move to our first concept. So what is liquidity and why do we use it? Let me draw something so you can understand it easily. So suppose these boxes are the pending orders in the market which have not been filled by the price. This simply means that the price hasn't traded at these levels yet. On the right side, suppose these are the price levels which are not yet traded by the market. Then the market simply fills these pending orders in one direction and then moves in the opposite direction to fill those pending orders. And the market always moves from liquidity to liquidity and keeps moving up and down to fill all the buy and sell orders at specific price levels. Now let's see on the charts how liquidity works. Now liquidity rests at the highs and lows of the price. So this is a high, so it is called the buy-side liquidity. Now, for example, suppose there are pending sell orders and buy orders above this buy-side liquidity level. Now, let's mark out our opposite side low, which is called the sell-side liquidity, and suppose, similarly, there are pending orders resting below this sell-side liquidity. So now the price has swept the buy-side liquidity, which means price has filled all the pending orders, and now it should move towards the sell-side liquidity to fill those pending orders. So look, after taking our buy-side liquidity, price simply moved lower towards our sell-side liquidity to fill these sell-side orders. Now we have a new high here, so this high now becomes our buy-side liquidity level. For example, now there are pending orders above this high. So let's see if price goes towards this high after filling all the sell-side orders. Look how price created a low and starting moving to the upside are filling all the orders that was resting below our sell-side liquidity level. That's called a liquidity sweep. Every time price takes out your liquidity level, it is called a liquidity sweep, which specifies that the price has absorbed the liquidity. So the price reached our buy-side liquidity level. Notice how price swept our sell-side liquidity and moved towards the upside. So this is the perfect demonstration of how price moves from the liquidity to the liquidity. And every time the price takes out one direction's liquidity, it simply moves towards the opposite direction's liquidity level. But you might think there are lows in between these highs and lows. And how can we know which specific low the price will take out and move from there? Because there are many highs and lows, but not every high and low is a liquidity level. For example, notice how price didn't take the other three lows and took this low and then moved towards the upside. Now, to spot these specific lows and highs, you have to understand the concept of external and internal range liquidity. So let's see what it is. So what is external and internal range liquidity? To explain that, let me make a diagram. So suppose this is the market structure, and we have buy-side liquidity and sell-side liquidity resting. Both of these liquidity levels are not swept. So how can we know whether the price will sweep the high or the low first? For that, we use internal liquidity, which is called minor liquidity levels. These are nothing but the highs and lows that are in between the liquidity levels, which price sweeps first and then moves towards the opposite side level. Now let's move on to the charts. So here we have a high, which is our buy-side liquidity, and we have a low, which is our sell-side liquidity. Now, if you look at these levels, we don't know whether the price will first sweep the buy-side liquidity or the sell-side liquidity. So to identify that, we have to use the previous structure. Look here, we can see that the sell-side liquidity has already been swept, so now we know that the price will continue to the upside. And in between this current structure, we have a low, which is our internal range liquidity level. We will wait for this low to get swept. So this low has been swept, and you can see that the price didn't sweep the sell-side liquidity and went straight to the buy-side liquidity. The buy-side and sell-side liquidity are called external range liquidity, and all the structure we have in between these liquidity levels is called internal range liquidity or internal range market structure. To find this internal structure, we always have to take the context of the previous liquidity sweep. Look, we have another low here, but it will never work. Why? Because the price has taken out our external liquidity level, and now we are no longer bullish. Now look at this. We have a minor buy-side liquidity sweep, and then we have a minor sell-side liquidity resting below. So to know what the price will do, we just mark this low here. Notice how, instead of moving to the upside, price displaced this liquidity level. So we know that the price will go towards the sell-side liquidity. And now right here, the liquidity has been swept. That's how the internal structure is used to determine what price will do next. Now I will explain how higher and lower timeframe liquidity works and how to use it within your trading model. So we are on the 4-hour timeframe, and we have our sell-side liquidity swept, and we know that the price will go towards the buy-side liquidity. Now, dropping down to the 1-hour timeframe, we have a low here, which is our sell-side liquidity. So this is called our internal range liquidity. Our 4-hour is bullish, so we have to look only for sell-side liquidity levels on every timeframe. Now look how price swept our sell-side liquidity and moved towards the upside. Now, once again, we have another low right here, which is our sell-side liquidity, and this is again our internal range liquidity. Again, the price swept this level and moved towards the upside. That's how you use a higher time frame, and then use lower time frame liquidity levels to trade in the same direction. Now we again have a sell-side liquidity, which is still our internal liquidity level because the external liquidity hasn't been swept. But notice how price didn't sweep this low and went straight to the buy-side liquidity. But wait, that's why lower time frames are used. Let's go back and shift to the 15-minute time frame. Now here we have a sell-side liquidity, which is our internal range liquidity. The price sweeps this low and then goes straight to the buy-side liquidity. Let's go back once again and shift to the 1-minute time frame. Here we have a sell-side liquidity, which is our 1-minute internal range liquidity. Price sweeps this low and moves towards the buy-side liquidity. Now this is a real example of how price is fractal and moves the same on every single time frame. The only thing you have to do is align the direction of the higher time frame and use it on the lower time frame to identify multiple high probability opportunities. Now in this part, I will explain what a fair value gap is and how to spot the right fair value gap. A fair value gap is a 3-candle pattern in which the first, second, and third candles leave a gap in the body of the second candle. The first and third candle wicks should not touch each other and should leave a gap in the body of the second candle. So this is called a perfect fair value gap. The fair value gap simply contains unfilled pending orders. You can see that there is a gap from $5 to $8. So all the pending limit orders that are in between this price gap are filled by the market, and then price moves towards its direction. So now let's move on to the charts and see how it works in real time. So on the charts, the first thing is that the buy-side liquidity is resting above, and we have a sell-side liquidity sweep, so we know that the price will go towards the buy-side liquidity. Liquidity is the foundation of every ICT concept. Without it, none of the concepts will work. Let's wait for price to create a fair value gap. Now we have a bullish fair value gap. Notice these three candles. We have a gap in the second candle, so this is a fair value gap. Look how price retraced into the fair value gap, and then it went straight to the buy-side liquidity after retracing this fair value gap. Look, this is the perfect example of how price retraced, filled these orders at these specific prices, and went towards the upside. Now let's see what an inverse fair value gap is. So we have a buy-side liquidity level, which we will mark. We also have a sell-side liquidity level resting below, which we will mark as well. Now our buy-side liquidity has been swept. So look here. We had a bullish fair value gap which has been broken, so this now becomes an inverse fair value gap. Our buy-side liquidity has been swept, and bullish fair value gaps are used to go to the upside. The price broke this fair value gap, which validates the inverse gap and tells us that the price will retrace to this gap and continue lower. Notice how price retraced to the inverse fair value gap and started moving lower, eventually ending up sweeping our sell-side liquidity. So now our sell-side liquidity has been swept, and we will look for an inverse fair value gap. So now we have an inverse fair value gap, which simply means that the price will go to the upside towards our buy-side liquidity level. Here, the price retraced back to the gap and went straight to the buy-side liquidity. So this is the way it works. You have to look for opposite direction fair value gaps to get inverted in order to validate an inverse fair value gap. Now let's see what an order block is. So here, look, we had a buy-side liquidity sweep, so our bias is bearish. Now look at this single bullish candle and these three consecutive bullish candles here. So whenever, after the liquidity sweep, the opposite direction candles get overlapped by the candles supporting our direction, it creates an order block. Only candle bodies are used, and wicks are not used. So this is an order block, and it means that the price would move lower towards our sell-side liquidity. Exactly the same thing is happening here. The price started slowly moving to the downside and ended up sweeping the sell-side liquidity. Now we have a sell-side liquidity sweep, and our bias is bullish. So let's wait until price creates an order block. Look here. We have two down close candles that get overlapped by bullish candles. So this becomes a bullish order block, and we will mark this. Notice how cleanly price tapped our order block and swept the buy-side liquidity. Now let's see what a breaker block is. So suppose we have this market structure. Look at this last high created before the down move after the buy-side liquidity sweep. And this was the last low before that high was created, so this last low becomes our breaker block. Price simply breaks it to the downside, and once it breaks, this validates the breaker. Then price retraces back to it and continues in its direction. Now look here. Suppose this is an order block and price respects it, and then after sweeping the recent low, it breaks it to the upside. Failed order blocks are also called breaker blocks. Why? Because this was the last low created, and these are the highs, which were the last highs before the up move. Now let's look at a breaker block on the charts. Now we have sell-side liquidity resting below, and we also have buy-side liquidity resting above. Let's wait for one of them to get swept. Now our sell-side liquidity has been swept, so let's wait for a breaker block to be formed. Look here. This was the last low before the up move, right? And this was the last high before the low was formed. So this high, which is also an order block, gets a bullish candle closed outside of it, so this becomes a breaker. Look how cleanly price retraced to our breaker and then started moving upside and ended up sweeping the buy-side liquidity. So what is change in state of delivery? A change in state of delivery shows that the order flow has shifted from one direction to the other. How does it look? After a buy-side liquidity sweep, the bias is always bearish. So look here. Can you see these two bullish candles? When price closes below the body of these two bullish candles, that creates a change in state of delivery, and after that, price continues in its direction. Now the same goes for a bullish scenario. After a sell-side liquidity sweep, price closes above this down-close candle, so it is also a change in state of delivery. Now look here. Our buy-side liquidity has been swept, so we will look for a change in state of delivery. Look here. Price displaced and closed below the body of these two up-close candles, which confirms the CISD. And now price should move to the downside. Look how cleanly it worked. That happens when you use change in state of delivery with proper liquidity levels and their context. Look, our sell-side liquidity has been swept, and now we have a change in state of delivery again, and buy-side liquidity is also resting above. Look how price moved straight to the buy-side liquidity. Now let's talk about market structure shift. For example, a bearish market structure shift happens when price sweeps a buy-side liquidity level, then creates a low, and then breaks it with displacement to the downside. As soon as a candle closes outside the low, it validates the market structure shift, and then price continues towards the opposing side liquidity level. Now let's see on the charts how it looks and how it is used. So look here. We have a buy-side liquidity sweep, and we have a low, but until now, it hasn't been broken to the downside. Now the candle has closed outside the low, so it is a validated market structure shift. Look how cleanly price started moving to the downside and then went straight to the sell-side liquidity, validating this shift as a high-probability market structure shift. Now look here, we had a market structure shift, but the buy-side liquidity is just above, so let's wait for this buy-side liquidity to get swept, and then we will look for a market structure shift to the downside, anticipating a sweep of sell-side liquidity. Notice how price went straight to the sell-side liquidity after breaking and closing below this low. This is how market structure shifts are used. Wicks are also considered in this. Now in this part, let's see what a daily bias and the draw on liquidity are. Daily bias is simply the direction in which we are expecting the market to expand on a certain trading day. It is only a direction, whether bearish or bullish. Look here, and suppose this is a sell-side liquidity sweep, and now you are expecting the market to go towards the buy-side liquidity. So what is our direction? Bullish. That's called the daily bias. Now the draw on liquidity is a liquidity level that we are expecting the market to sweep from a certain liquidity level. It should be a specific liquidity level that you are expecting the market to sweep. Look at this diagram. Suppose you have a sell-side liquidity sweep, and now price is at a fair value gap. A buy-side liquidity is resting above, and there is another buy-side liquidity resting above that. Now suppose we are expecting price to sweep this buy-side liquidity level, but only after the sell-side liquidity sweep and at the fair value gap. Then price exactly does the same. So what is this? This was our draw on liquidity. Now let's move on to the charts and look at how it works. Now we are on the daily time frame, and we have a daily buy-side liquidity sweep. So our daily bias is bearish. We have a sell-side liquidity here, and we know that the price can sweep this low, but this low right here is near. So let's mark this sell-side liquidity. So now this sell-side liquidity is where we are expecting the price to trade. So this is our draw on liquidity. What is our daily bias? Our daily bias is bearish, which means we will ignore all bullish opportunities and focus entirely on bearish opportunities to target our draw on liquidity. Now, dropping down to the 4-hour time frame, we have a swing low right here. So for now, this is a liquidity level because price hasn't displaced it yet. Now this sell-side liquidity level has been displaced, and we have a market structure shift, which is our confirmation. So the price started moving to the downside, respecting each and every single fair value gap along the way, and finally swept our sell-side liquidity, which was our draw on liquidity. Let's clear it again. This level right here, what was it? it was our draw on liquidity, and our daily bias was bearish. Now again, we will mark the sell-side liquidity. Our buy-side liquidity has already been swept, and we are expecting the market to go towards our sell-side liquidity. We also have a market structure shift to the downside. Now this simply means that our draw on liquidity is the sell-side liquidity, and we are expecting the price to sweep that level. Now moving on to the 4-hour time frame, price is moving slowly but displacing to the downside, and then it sweeps our sell-side liquidity, which was our draw on liquidity. Now in this example, we are on the daily time frame, and our sell-side liquidity has been swept, so our daily bias is bullish. Now we will drop down to the 4-hour time frame. We have a 4-hour market structure shift to the upside, which is enough for our confirmation. Now we will mark the high as our draw on liquidity, but it is only for the 4-hour time frame. Price is continuously moving to the upside, and now I can see that we have a fair value gap here, and once again, we have a market structure shift to the upside. So let's drop down to the 1-hour time frame and see what price is doing here. Here the price is also moving to the upside by creating displacement. So look here. Now the price retraced back to the 4-hour fair value gap and swept this sell-side liquidity. So on the 1-hour time frame, this is a swing high and a buy-side liquidity level, which becomes our draw on liquidity that we are expecting after this sell-side sweep. Now let's shift down to the 15-minute time frame. Here we have a low which is getting swept, which means that it is our sell-side liquidity on the 15-minute time frame. We just need confirmation right here, and I am expecting the price to create a change in state of delivery. A huge candle moved to the upside, creating a change in state of delivery, and we have a fair value gap here. So we will enter on this gap, place our stop at the low, and target our draw on liquidity. The price instantly triggered our order and went to our draw on liquidity. So let's clarify it. We had our draw on liquidity here, and we had our sell-side liquidity swept from where we were expecting the price to move towards our draw on liquidity. Then we entered with confirmation and hit our target. This is exactly what I am trying to explain. You can have a bullish bias on a higher time frame, but your draw on liquidity can be the recent high or low on a lower time frame. You don't have to target or trade the entire range. In this part, we will learn about premium and discount and how they work. The premium and discount tool is a tool that divides the price into 3 parts. We apply it from the high to the low of the range. To understand this, suppose you are buying at $10. It is obvious that you want to sell it at a higher price, like $30, in order to make a profit from that transaction, right? Now suppose you are selling at $30. It is obvious that you want to buy it back at a lower price in order to gain a profit. That is the reason the premium and discount tool is used. Suppose you have this type of market structure and you apply the premium and discount tool on this range. If we go short around $20 and price reverses from $10, we will get nothing. Or if we get something, it will be very little. Now suppose if you sell around $30 and price reverses from $10, it is clear that you will make a good move out of it. Now let me make it more simple. Suppose we are going to take a long position, which means we want to buy. What we have to do is simply wait until price comes below the 0.5 level, which means it is in the discount range. We also have a liquidity sweep here. Now if we buy here, see how big of a move we can catch. And if we buy here, what will we get? Now for selling, look here. Suppose we are selling somewhere around here. See how little of a move we are catching. But if we simply sell in the premium zone, which is above the 0.5 level, then look how much bigger of a move we can easily catch. So it is obvious that we have to buy in the discount zone and sell in the premium zone. You can see the settings of my premium and discount tool. Just take a screenshot and set your tool to the same settings I have. Now let's move on to the charts, and I will explain how to use this tool. So coming to the charts, look, we have a swing high and a swing low. So we will apply the premium and discount tool on this range. Our bias is bullish. Why? Because if you look to the left, we had a swing low here which has been swept. This simply becomes our sell-side liquidity sweep, and now the price should move higher. So every rule is followed here. We are under the 0.5 level, which means we are in the discount zone, and we are bullish, so we want to buy. Look, we have a change in state of delivery here, so we will just enter long, place our stop at the low, and target the high as our buy-side liquidity. And now we are expecting price to move to the upside, so we can get our target. Look how slow, but still, price is displacing to the upside, and finally it gives us our target. So let's clarify it again. If we want to buy, we have to wait for price to get under the discount level, give a liquidity sweep, which means that price will no longer move lower. If we position ourselves here, we will get a far better entry than at any other level. In this part, we are going to learn what standard deviation is and the right way to use it. Standard deviation is just a tool that gives you projections for price to run up to those projection levels. To correctly use this tool, look at this example. We had a buy-side liquidity sweep, which means price should go lower. As soon as we get a market structure shift to the downside, we can use this tool. But from where? We have to apply this tool from the high, which was the last high after the liquidity sweep, to the low, which was the last low before the market structure shift. This high and low are called the manipulation leg. And once you apply this tool, it will give you some projections, like these 3 levels you can see. You can use this tool if your liquidity sweep is too near and you want to set bigger targets, or if you want to hold trades even after the opposing side liquidity gets swept. Price almost every time meets the projection levels, and it works really well. Now let's move on to the charts and see how to use it. So coming to the charts, we can see that a swing low is getting swept, which means our sell side liquidity is getting swept and price should move to the upside. We also have to mark the buy side liquidity to know that price could continue towards it. Now let's wait for a market structure shift. Look here. Now we have a market structure shift because the candle closed outside this high, right? This is our market structure shift. Look, this was our last low after the sell side sweep, and this was our last high before the market structure shift. So we will apply the standard deviation tool from the low up to this high. So we will enter right here, place our stop at the low, and target our projection level, which you can see is much farther than the buy-side liquidity level. Look how price moved instantly to the upside. Look here, how price is rejecting from the projection levels without even taking out the buy-side liquidity. Price continuously displaced slowly to the upside, became a bit sideways, but still met the projection level of our standard deviation. This works perfectly, and if you use it correctly, you can target very large moves. In this part of the video, I will explain the ICT easiest day trading model. So let's look at the time frames we are going to use in this model. First, we will use the daily time frame for bias and key levels. Then we will use the 4-hour time frame for liquidity and fair value gaps. Then we will use the 1-hour time frame for identifying liquidity levels. Then, on the 15-minute time frame, we will look for confirmation, and then we will enter. Now the concepts we are going to use. First, we will use liquidity, then fair value gaps, and inverse fair value gaps, then order blocks. And lastly, we will use market structure shift and change in state of delivery. Now let's move on to the charts, and I will show you how to use this model. Coming to the charts, we are on the daily time frame, and first we have to identify where we are currently. I can see that we have a daily sell-side liquidity sweep, which means that the price could go higher. I can also see a high here, so let's mark this as our buy-side liquidity. We are at a daily bullish fair value gap, so we will mark that out as well. So we have a sell-side liquidity sweep, we are at a bullish fair value gap, and we have buy-side liquidity resting above. So we know that this low will stay protected and the market will sweep the buy-side liquidity. Next, on the 4-hour time frame, we have to observe the market structure and identify what we can use. Our daily time frame is bullish, so I will look for bullish opportunities only. So I can see that we have a 4-hour bullish fair value gap. What makes this fair value gap high probability is that we also have a 4-hour market structure shift to the upside. We know that price will retrace into this fair value gap and then move towards the buy-side liquidity. Next, on the 1-hour time frame, we have to observe and find liquidity levels that we can use for a liquidity sweep. We are bullish on the daily and 4-hour time frames, so we will look for sell-side liquidity. I can see a low here, which is also within the 4-hour fair value gap, so we will mark this as our sell-side liquidity, and we will go long after this sweep. So the last step is that we have to get our confirmations, and then we will enter on the 15-minute time frame. First, let's wait for price to sweep our sell-side liquidity level so we can look for confirmations. Now the sell-side liquidity has been swept. First, we will mark the buy-side liquidity level so we can target that level. Now let's wait for confirmation. Now we have an inverse fair value gap, which means we can enter right here. So we will enter here, place our stop at the low, and target the buy-side liquidity. The market instantly moved towards the upside and gave us our target. Now I will show you the ICT easiest scalping model. First, let's look at which time frames we will use in this model. First, we will use the 15-minute time frame to look for liquidity levels. Then we will use the 1-minute time frame for confirmations and entry. Now let's look at the concepts. We will use fair value gaps and inverse fair value gaps, then order blocks and breaker blocks. And lastly, we will use market structure shift and change in state of delivery. Now let's go to the charts and look at how to use this model. First, on the 15-minute time frame, we will look for liquidity levels. Here, I can see that we have a 15-minute buy-side liquidity sweep, so we know that the price will move lower now. But we will not target the 15-minute sell-side liquidity. On the 1-minute time frame, we will look for confirmation, and then we will enter. Let's zoom in and look for confirmation. Now we have a change in state of delivery. So we will enter here, place our stop at the high, and for the target, we will use the recent 1-minute low as our target. So we will mark this out. You can see that price is moving lower slowly and ends up giving us our target. This is an easy but powerful setup. I want you to slow down and really feel what I'm about to say. If you pay close, undivided attention to every single moment of this video, if you let each concept sink in instead of rushing, instead of skipping, then you'll realize something powerful. This entire video is designed to make your understanding of the market. Every explanation, every example, every subtle detail is placed with intention. Nothing here is random. When you truly focus, when you stay present from start to finish, you'll notice that all the pieces begin to connect, like a perfect rhythm, smooth and controlled. By the time you reach the end, you won't be left craving answers. You'll already be holding them. You'll have everything you need to step into the market with confidence, precision, and calm dominance. This isn't about chasing trades or getting lucky. It's about understanding the flow, letting the market reveal itself to you, and knowing exactly when to act. Watch it slowly. Absorb it deeply. Let it change the way you see price, risk, and opportunity. Because if you truly pay attention, this video gives you all the tools, all the mindset, and all the clarity required to become a consistently profitable trader. So, thanks for watching. And before you close this out, understand this. If you genuinely want to keep leveling up, you don't have to do it alone. If this video helped you see the market with a little more clarity, then the next step is simple. Join my Telegram and Discord and stay connected. Inside, you'll get daily market overviews that break down what actually matters, not unnecessary noise. You'll get educational content that builds your understanding step by step, helping you refine your entries, your patience, and your execution. And you'll be part of a serious trading community, people who are focused, disciplined, and committed to becoming consistently profitable. If you're looking for something deeper, something more personal, where your mistakes get corrected, your strengths get sharpened, and your mindset gets locked in, then check out the one-to-one mentorship. That's where real transformation happens. The link is waiting for you in the description.